Felix here. You may have noticed this has been the best July and August ever in stock market history. What does that mean? Well, it's the summer rally of all summer rallies. I hope you've enjoyed it. But what's coming next? That's really the question we need to ask ourselves. So what we're going to do, we're going to look at each one of the previous major summer rallies. We're going to look at, I think, 4 key indicators and lots of facts. The occasional cat will walk through the screen. I can't help that. But before we do that, we're going to get our hands on Bank of America's top 18 cheap stocks that they say are going to benefit from onshoring in the US. So head over to felixfriends.org/B-of-A. It's free. Why do I put these out for you? Because I very, very strongly believe looking at data makes you better investors. Here it is. Let's put the whole beautiful benchmark. You get ROIC numbers, you get interest coverage ratios, you get PE, forward PE, long-term earnings growth, all that stuff. So download it and go nuts. And of course, none of the following financial advice. You know that by now. You also know that we have the greatest disclaimers ever. And I'm trying to say that as quickly as I possibly can, so we can move on to the real meat of the story here. Well, plant-based meat in my case, but that's beyond the scope of this channel. What's going on here? Well, we've got a thing of beauty, which I'd like to show you, but my pen is on strike. Can you see this blue bar here while my pen is on strike? Microsoft, please give me my pen back. We truly appreciate it. Here we go. So that is the biggest 15.1, what is it? No, not quite, but something like that. 13% or so rally in July, August. So it's the best summer performance ever. What was also pretty good? Well, 2020 was pretty good. That was the post-COVID rally. That made sense. Then we had 2009. That was pretty good, but not quite as good. And then we had, very interestingly, 1970. Why is it very interesting? Usually that's what economists tell you when something's really, really boring. I apologize, former economist, former banker, that sort of thing talking here. But 1970s had similar inflation to what we're seeing right now. So we're going to look at that data and we're going to compare it and see what actually happened. So I've already prepared a chart for you on that. We're going to get to that in just a second. But just so you know, I'm not fibbing to you, here is the beautiful chart we're going to look at. Before we do, let's have a quick look at what the smart money, the so-called smart money, is expecting to happen here. Well, what they expect is that the red line here, which is US corporate bonds, they expect corporate bonds and, quite frankly, US treasuries, so US government bonds, to, what do you think? Go up. Because people are de-risking, people are looking for these now higher bond returns as interest rates go up. And so they expect this gap here to widen and therefore for there to be a bigger bond rally and a smaller stock performance. That's the prediction there. Why do they say that? Well, there is something called the rule of 20. I've mentioned this before in previous videos. The rule of 20 is, again, it's a Bank of America invention, really, if you can call it that. It's the S&P 500, so basically SPY, past PE ratio minus the CPI data, so minus inflation. And it's a bit of an odd number, but their quants have come up with it, and I understand they have square heads, and they're very, very smart. And typically, pretty much every rally we've had, every major rally we've had was, here is the COVID one, was preceded by this magic number falling below 20. Actually, sorry, this is COVID. This is the COVID one. This was 2009. And right now, we fell only to about 27, something like that, 26, 27. So we did not go all the way down to then go all the way back up. So they call the market bottom, essentially, or something like the market bottom when we get to that 20 level, and we haven't done that. Separately, inflation is still pretty strong, although it's moderated slightly, but the US jobs market is incredibly strong, picking up once again, And you can see down here, it's a 50-year low on unemployment. Now, you can argue about whether that's the real number or not, but it's definitely very, very, very low. But for certain stocks, I would be a little bit depressed on this. Before we go to this for certain stocks, I want to show you what happens in each of the months that preceded these massive rallies in the market. So here we are in the 1970s. You're wearing very, very wide trousers. You've got dodgy looking hair, and you're probably smoking lots of, herbal substances. So this was July, this was August, 7% plus 4%, September, 3%, October, 1% down. And then in November, December, the rally continued. Why? Because it was the beginning of a real rally, one of the many that the 1970s experienced. They went through a real boom and bust kind of a phase there, a lot to do with interest rates and inflation. Now, 1989, so far we're thinking, well, actually, one of these great summers might be a good thing. Well, 1989, not quite so beautiful. That was the other one. That was quite a big one. We had... In July and August, we went up something like 10%, and then in September, we went down 0.65%, October down 2.5%, and then we sort of bobbed sideways and then actually had a proper decline the following year. So that wasn't really a great one. But let's look at the next one. We've got 4 of these. We've got plenty of data to look at, and look at that. August going up, July going up massively here, these 2 months, and then September continues. So there is no real rule that just because you had a beautiful summer that you need to believe the doom and gloomers, the crash channels, all that kind of stuff. Same again in 2020, the COVID recovery, obviously. July was beautiful, 5%. August was 7%. September, -4, ouch. October, -2, ouch. And then November, we continued with the stimulus and the rally to the top of 2021 when the market really started to correct again. So is there therefore a rule in this? No, there isn't. Now, the rule of 20 thing I think is a little bit more sensible, and I would be bearish but for the great performance of the big tech stocks, which make up now most of the indices we look at, Apple, Amazon, and so on. And I put out here for you on the screen, I hope you can just about see that. The first row is Amazon, the second row is Apple. This is ROIC. And why do I look at that? I think it's one of the greatest indicators ever out there. And if you look at where they came from say, 2009, they had 14% ROIC, 16%. Where are we now? 11%, 27%. Pretty solid, really. I mean, Amazon, they spend a lot of money. They've invested a lot of money. They're going to cut some costs. I do think that's going to improve. But Apple here performing some real magic. And that's really one of the reasons that the market continues to go up and up and up. It's certain big, juicy companies, tech companies getting more efficient, making more money. And also bear in mind this here, and this is one of the things I always post on my Discord. If you want to get there, go to Patreon. We've got a crash channel just to keep people calm. Any 20-year period that you were invested in the S&P gave you a 100% guarantee that you made money. So if you're in the market long enough, you're guaranteed to make money. In a sense, you don't really need to worry about what happens in September or October as long as you stay invested. And then the whole timing thing, and I've showed this in 6 months ago, something like that. We do it every once in a while. People get worried about crashes. Look at the returns since 1930. If you'd stayed invested in the market, well, it would have been 17,000%. Now, of course, this is what the market timers will tell you. They say, well, if you'd avoided the worst 10 days each decade, so the worst day each year, essentially, well, you would have made 3.8 million % return. Isn't that marvelous? Yeah, but what's the likelihood of you finding that? If you'd missed the 10 best days, which quite often follow the 10 worst days straight afterwards, you would have only made 28%. So the risk reward here is either you make a whopping 3 million %, or you make only 28%, in which case you might as well throw yourself off the nearest building, or you can get a guaranteed 17,000. So that's basically your like pauper gazillionaire or millionaire in the middle. Those are basically your choices. So, it's up to you. Does that mean you should never do anything to make your returns better? No, of course not. I keep and hold and keep adding stocks to my portfolio. And that's, I think, the smartest thing to do, whether I'm a former banker and all that. But you can make a heck of a lot of money. Here's two examples from two of my students who are still paper trading. They're brand new to it. In 3 weeks, Andrea has made $4,000. That is from just $20,000. I say just. That's from $20,000. So that's a whopping 20% return here, which is absolutely fantastic. Congratulations, Andrea. Here's another one, Will, who has made $4,500 here in how many weeks? In 2 weeks, based on $50,000. So that's also a 9.5% return. So you can turbocharge your investments by being smart with your investing. To learn more about that, head over to felixfriends.org/coaching. That's to work with us directly, one-on-one, and in some more coaching groups. And then we also have the slightly do-it-yourself Master Options program, which is here at felixfriends.org/options, a brilliant program, over 100 lessons and so on, gets you to the same outcome. Maybe just it takes a little bit longer. So my returns, I'm always transparent with them. I show it to you all the time, warts and all, losses and all, wins and all, always share that with you. 9% up so far on the month, 118% since the beginning of the year. And I know some people struggle to believe you can do that. But for me, the real eye-opener was doing a stint at an investment bank and sitting on a trading floor. And suddenly I met all these people around me who were lovely, but not necessarily like Einstein. And they were making a boatload of money. They were not expecting 8% a year. They were more expecting this kind of number down here. And it is possible. It's possible for retail investors. Why do you think banks employ traders? Well, there's a very simple reason for that. But don't trade stocks, I would say. I think that's a very risky thing to do. Buy stocks for the long haul, for the passive income, and then to boost your returns. You know what I do. I trade options. We sell options. So we do the opposite of what most retail investors do. So please don't buy options. Please don't buy leap options. Please stop gambling on the direction of a stock. We don't particularly care which way the stock goes, up or down or sideways or in round and round in spins. We make money. We largely make money out of volatility rather than out of the actual stock price movement. So to learn that, you know where to go. Here we go. Give us a call at felixfriends.org/coaching or join the community here of 2,500 students on the Master Options program. felixfriends.org/options. Coupon code there is 41% off freedom. If you enjoy these little macro updates from a retired economist, former lawyer, former banker, all that kind of stuff. My mission is really just to get people to financial freedom. That's really what I sincerely wish to achieve with this channel, that we get 100,000 investors financially free and therefore get 100,000 families to intergenerational wealth. Never worry about money again. Do what you want to do. If that's sculpting or painting or whatever it is that you actually enjoy doing, let your creative juices flow. You can only do that with money, or go for a swim with your dog every day, that kind of stuff. Time freedom requires money freedom, and therefore we need to get to that. It's the most important investment you can make. Thank you very much for watching. I didn't really take a breath in that one, did I? Apologies for that.